Okay, students, let's start this question. This question came in June 2026, section C. It's a 10 marks question. Calculate overall amount of tax which Kahuna and Jacey will save for the tax year 25-26 if they undertake three tax planning measures which you have identified. So the entire question is on tax planning. In support of your answer, you are expected to prepare full income tax and capital gain tax computation for both Kahuna and Jacey. Okay. Let us read and see what are the tax planning. You should assume that, excuse me, you should assume that today's date is 15 March 2025. You are a trainee, chartered certified accountant dealing with the tax affairs of Kahuna and Jacey. A married couple. Okay. Before taking account of any tax planning measure, you have prepared a forecast couple tax position for the tax year 25-26. Kahuna will have income tax liability 42,508, but this income tax liability is before the tax planning. This is based on taxable income 1,27,000. So Kahuna's taxable income is 1,27,000, consisting of gross director's remuneration is 1,16,000. Okay. Dividend income is 11,000. Unused capital loss is 13,100 brought forward. We know that whenever we have brought forward capital losses, how do we utilize brought forward capital losses? First, in the current year, from the current year chargeable gain, we will deduct the current year capital loss. After that, you will deduct annual exempt amount, and after utilizing the annual exempt amount, you will actually use the brought forward capital loss. So for day, kindly do not use anything from the Zoom. Thank you. Okay. Now, Jacey. Jacey will have an income tax liability 1506. Again, this income tax liability is before the tax planning. This is based solely on employment income 20,100. Jacey will also have a capital gain tax liability 9230. This is in respect of disposal of quoted shares, which will result in chargeable gain of 49,000. The disposal will not qualify for badder. Okay. Now the examiner is telling us tax planning measures. After a meeting with Kahuna and Jacey, you have identified three tax planning measures which the couple could undertake for the tax year 25-26. Kahuna quoted shares will be put into joint names so that Jacey will receive 50% of the dividend income. Okay. Right now, entire 11,000 dividend income is with Kahuna. But by following point number 1, 50% of the dividend income will be, let's say, remain with the husband, 50% will go to wife. And 50% of 11,000 is 5,500. Kahuna will contribute 20,000 net into personal pension contribution. 20,000 net means it is 80% and we have to gross it up. So 20,000, 100 upon 80. Logically, gross personal pension contribution is 25,000. Gross, and we know that basic rate band, which is 37,700, basic and high rate band, both will increase by gross PPC. Plus, we also know one more thing. Adjusted net income will also reduce by adjusted net income will reduce by 25,000 gross PPC. And we also know one thing: if someone is having adjusted net income more than 1 lakh, then your personal allowance for that individual reduces. But if someone is having adjusted net income either 100,000 or less than that, then that individual gets entire personal allowance. Jesse's quoted shares will be put into joint name prior to their disposal. So right now, Jesse will also have a capital gain tax liability of 9230, and there's a capital gain of 49,000. And they are saying Jesse's quoted shares will be put into joint names prior to their disposal. If Jesse's quoted shares will be put into the joint names, it means that this capital gain will be split 50-50. If examiner does not mention anything, then obviously it will be split 50-50% between husband and wife. Okay. First, we have to calculate income tax liability for Kahuna. Then we will also calculate capital CGT for Kahuna. Then we'll do the same thing for Jesse. Just an idea, then I'll show you how to properly present this on the spreadsheet. But right now, let me just give you a little idea. Taxable income is 127, but out of this taxable income, director's remuneration is 116. It means, just an idea, non-saving income is 1,16,000. And we have got dividend income. Now, dividend income will not be 11. Because if you read point number 1, quoted shares will be put into the joint names. So it will be put on the joint name. So dividend income will be split 50-50. If I take 50% of 11,000, I'll get 5,500. One more thing, Kahuna is going to contribute 20,000 net in gross in personal pension scheme, which means that right now his, let's say, non-saving income is 1,16,000, dividend income is 5,500. If I add, this is now Kahuna's net income. From this net income, we'll deduct gross PPC, which is 25,000. It means that now Kahuna's adjusted net income is going to be less than 1 lakh. So can I say whoever is having adjusted net income either 100,000 or less than that, that person gets 100% personal allowance. And we know one more thing. Personal allowance will be deducted from the non-saving income. Then we also know one more thing, that basic and high rate band of Kahuna will increase by gross PPC. Okay. So what else? Then we'll calculate the income tax liability of Kahuna. One more thing, Jesse is having a capital gain of 49,000. Now try to understand. Jesse is having a capital gain of 49,000, and look at the point number 3 of tax measure planning measures. Jesse's quoted shares will be put into her joint names prior to their disposal. So this capital gain will be split 50-50, which means that the gain, capital gain for Kahuna, if you take 50% of 49,000, it is 24,500. So 24,500 capital gain will be with Kahuna. Kahuna does have a brought forward capital losses. But first we have to utilize current year annual exempt amount, which is 3,000. After that, we'll utilize brought forward capital loss, which is 13,100. So here comes the taxable gain, 24,500 minus 3,000 minus 1,300. Taxable gain is 8,400, and we'll apply 24% on this. Why 24%? One, it is mentioned in the question, badder is not available. And second, obviously, Kahuna is having 96,500. That is A&I. Kahuna is having income which is far more than, I would say, the basic rate band. So obviously, in case of Kahuna, there will be no space in the basic rate band. That is why whatever the taxable gain comes, we will apply 24% on that. Now, just an idea for Jesse. Jesse employment income is 20,100. Okay. And 20,100. Now, in case of Jesse, what happens? Non-saving income is 20,100. 50% of the dividend income will be transferred to Jesse, which is 5,500. Then we'll deduct personal allowance from here. Then we'll calculate income tax liability. And after that, we will also calculate CGT. 24,500. We'll deduct annual exempt amount. We'll get taxable gain. And before applying any tax rate on this taxable gain, we'll check how much space we have in the basic rate band. If the entire taxable gain falls in basic rate band, let's say if we have that much space in basic rate band, then we will apply 18%. Then once we have calculated, we have calculated uh, income tax liabilities and I would say CGT, then we'll check what was the income tax liability and CGT liability before tax planning and what is the income tax liability and CGT after tax planning. And difference is going to be the saving. So let me just share spreadsheet. Then we'll be doing this on the spreadsheet. And let me pause the video as well. Otherwise, video becomes very long. Just a minute. It is, let's say they are saying part A. Income tax liability of Kahuna. Okay. We have got non-saving income and dividend income. Non-saving income. Dividend income, and let's take the total. Directors remuneration. Directors remuneration amount is 1,16,000. Let's write this in the column of total as well. Dividend income will be 50%. Dividend income will be 50%. Just a minute. Dividend income will be 50%. Earlier it was 11, is going to be now 50%. Total income. Now, should a very important point. Kindly listen to me. Okay. We can see that there is 1,21,500 is the net income. So directly do not deduct personal allowance. You have to show your examiner. the working of adjusted net income, because we know that adjusted net income is less than 1 lakh. That is why entire personal allowance is available. But if you're not simply showing working of ANI and directly deducting the personal allowance, you will lose marks. So less personal allowance, working one. Okay. Let me show you working. We can do the workings here. Net income. Students, net income is this. Simply less gross PPC. Net is 20,000. Multiply by 100 upon 80. Here comes adjusted net income. So ANI is actually less than 1 lakh, so the entire personal allowance is available. So we will deduct 12,570. Taxable income. Okay. Now, students, we know that due to gross PPC, the basic rate band limit will increase. Basic rate band, it is normally 37,700, but now it will increase by gross PPC. This is basic rate band. Okay, obviously, first we have to apply income tax rates on non-saving income. So applicable rate is 20%. Now higher rate band. We know that remaining total taxable income in the column of non-saving is 1,03,430 minus this. Difference actually falls in higher rate band and applicable rate is 40%. There is no need to show your examiner that higher rate band limit will also increase. Why? Because the entire taxable income of this individual is not more than 1,25,140. Of course, we know that due to gross PPC, your higher rate band limit also increases, but logically, that increase does not have any impact here. Why? Because the total taxable income is far more than even the normal higher rate band limit. But still, if someone wants to show that, then you can show that separately in the working. Otherwise, there's no need. Now, students, we will apply tax rate on dividend income. And when it comes to dividend income, I strongly believe now, of course, everyone knows that every individual gets nil rate band of £500 for the dividend income, irrespective of their, I would say, tax paying status. Dividend nil rate band 500. Again, higher rate band, dividend income. The remaining dividend income is 5,000, obviously falls in higher rate band. Applicable rate is 33.75%. So here comes income tax liability. Okay. Now should we know that whatever the capital gain, Jesse is having a chargeable gain of 49,000. Out of that 49, 50% now actually belongs to Kahuna due to that tax planning measures. So we have to calculate CGT for Kahuna as well. CGT, chargeable gain, let's say 49,000, 50% belongs to Kahuna. Less first annual exempt amount. Annual exempt amount. Do not first utilize your brought forward capital loss. Now we will deduct brought forward capital loss. Student, if you see the brought forward capital loss is 13,100. So here comes taxable gain. On this taxable gain, applicable rate is going to be 24%. Why? Because there's no space in the basic rate band. We know that because we have just calculated income tax liability for the same individual. So simply CGT liability, let's say at 24%. We'll take this, multiply by 24%. So CGT liability is going to be 2016. Now we will be calculating income tax liability and CGT liability for Jesse. Let's do this. Jesse, income tax liability. Now Jesse does not have only employment income. Jesse does also have now dividend income because 50% dividend income belongs to Jesse. So one column is for the non-saving income. Another column is for dividend income. And let's make one more column for the total. Just okay, employment income. Employment income of Jesse is 20,100. Dividend income is 50% of 11,000. So just to save the time, I'm directly deducting. Okay, let's do no issue at all. Total income. Less personal allowance. So here comes the taxable income. Taxable income. Entire 7530, of course, basic red band. Basic red band. Applicable rate is 20%. we know that when it comes to dividend income, every individual gets a nil rate band of 500. So dividend nil rate band 500. Now again basic rate band, but dividend income. Eight point 75%. Here comes income tax liability. Let's use the sum formula. Now we'll calculate CGT for Jesse. Chargeable gain. Again, it will not be 49,000. Entire 49 now does not belong to Jesse. 50% of that. Jesse does not have any brought forward capital losses, so simply less annual exempt amount, annual exempt amount. Here comes taxable gain. Now, on entire 21,500, we'll apply 18% because Jesse does have more than enough space in basic rate band. Because in basic rate band, we have only utilized 13,030. We have enough limit to adjust the entire 21,500 in basic rate band. If you want to see, just if I just show you 37,700, this much limit is being utilized. So we still have 24,670 in the basic rate band. So simply CGT at 18%. Now let us calculate overall amount of tax saving. Overall tax savings. Okay. First of all, look at this Kahuna. Income tax liability is 42,508. Kahuna does not have any, I would say, CGT liability. Plus Jesse's income tax liability is 1506. Jesse is 1506. Plus Jesse's capital gain tax liability is 9230. Now let us deduct what are the income tax liabilities and CGT which we have calculated. Income tax liability of Kahuna is this minus the CGT liability minus income tax liability of Jesse minus in CGT liability of Jesse. So students, overall tax saving is 14,895. That is the overall tax saving. So I strongly believe the entire presentation, everything should be 100% clear to everyone? Now kindly listen to me carefully. We do have two more questions in this June 2026 past paper, and already admin has already shared questions and answer in your WhatsApp groups. But don't worry at all. First, you have to attempt both the questions by yourself. If you have any queries, you can always ask the question directly from me in relevant WhatsApp groups. Second, uh, what we'll be doing in coming live revision classes, we are going to discuss the remaining two questions of June 2026 as well. Number one. Number two, now I strongly believe that you people have already seen all the lectures which are already uploaded on the portal, because now obviously the exams are very near. So make sure you should have completed all the lectures. All lectures means you should have seen all the lectures plus the practice videos, plus there is a crash course which is already uploaded on the portal. And within that crash course, within 5 to 6 hours, I have given you the revision of entire taxation, means entire taxation. From 17th of August, we will be starting a new crash course and that will be live. But the point is, that will be live and it is free for everyone. Those they are going to come and just attend the live class. The recording will only be available to those individuals they are enrolled with us. Obviously, if someone is not enrolled, that person will still get the recording of the crash course, but only one class. Remaining classes recording will not be available to unenrolled students. So that is why it is highly advisable that unenrolled students should not miss even a single class. So students, try to complete your lectures. If you still you have any remaining, any of your lectures are remaining, then try to complete as soon as possible. And plus try to complete the Kaplan kit as well. While practicing from the Kaplan kit, if you have any confusion, any question, any queries, you are more than welcome to ask question. So that is all about today's class. Thank you very much that you people have taken out time for today's class. Do give the feedback about today's class in your relevant WhatsApp groups. Thank you very much. And this lecture will be uploaded on the portal within next 2 hours, inshallah.